this week it is much more involved than previous 2 weeks or 3 weeks, I guess. Going more than 3 hours. Please bear with me. I'm sorry about that. But because partly because next week is midterm exam week, right? But next week you'll be able to turn this video again on, okay? And I recognize this as your attendance, right? But at the same time, you don't want to go too slow, right? Over the last couple of weeks, you did not have any materials to study except for the special lecture by Tim Lung, right? So you have some more reason to study this week, right? Okay, the R coding for Lasso is left. Okay, R coding. Of course, this is going to be your subject of midterm exam, so that's why I'm covering this one. You'd better watch this one this week instead of next week. Don't wait, okay? So lasso regression, how do we do that? Well, library has to be activated, GAMLR, right? And then here, okay, you have to do you have to create some sparse matrix, right? Sparse matrix, and then partly because sparse matrix is because remember the lambda and beta, all these kind of betas, right? Their values when lambda is big, that is our starting point, has to be what? 0. Absolutely big lambda, well, it's too much penalization. So to minimize that, right, to satisfy that constraint, the beta, all those betas of your 100 different variables, those betas have to be 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, right? And then you reduce lambda by 1 unit, a little bit, little by little, all those beta will be 0, 0, 0, 0, 0, 0, 0. And then at some point, one of your betas will start to pop up. I am significant. And the rest of the betas, still hundreds of them, will be 0, 0, 0, 0, 0, 0, 0, right? So you can think about this, a matrix. You can creating a matrix of betas to be able to generate that plots, right? The betas with respect to lambdas. So that betas, most of it will be 0, okay? But you don't need to have a full matrix of representing 0, 0, 0, 0 over there. But sparse matrix will take care of that. In that sense, all zeros are ignored, and the non-zero items, well, obtain those values, and then identify those coordinates, which beta, okay, at what point, at what lambda point is non-zero, obtain the value. So you're going to have 3 items over there. X coordinate, Y coordinate, and then the beta value, okay? X coordinate, Y coordinate, kind of a lambda kind of sense, I would say. Where is it non-zero, okay? And then beta 1, 2, 3, 4, 5, that's another coordinate. So that's going to be the sparse matrix. We create that by using this fail and data SC, and then SCX is created. Let's see. SCY is also created. Okay. Here, right? SCX. If you look at it, it's not like regular matrix, but something else, right? Something else. And then SCY is a vector like that, 0 or 1. That's your response variable of, semiconductor failure. Okay, fit a single lasso. Okay, that's this one, GAMLR, the library you brought up, and then SCX and SCY, binomial model, and plot this lasso. Okay, semiconductor lasso will be created, and voila, voila. You see this, right? Path plot of this, right, lasso is created over here, right? Yeah, yeah, yeah. And then you're gonna see. Can I? Yeah. Here, copy plot, right? And then perhaps if I throw it away, throw it here, right? You see this, okay? How many betas? The lambda, log lambda, right? You see the MSC minimizing point, ta-da, over here. So that's this. Easy. Good. Yes. AICC's corrected one, right? AIC. You do it with this kind of codings. And BIC, you can do it over here, right? Like this. And then cross-validated lasso, you can do it with these codings, right? SCX, SCY, family binomial, verb, true. So you're gonna see the explanations, right? By the way, fold 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And then folding is done like that. And then the mean squared error is estimated with some errors in it. So you have folded, so you have different out of sample testing going on with it. Okay, and then mean squared error or the binomial deviance this time, right, is shown. Why is there a range? Because let's say you have 10 times folded it, then you have 10 different versions of 10 different values of the deviances, right? So that's why you have average of the mean, the deviance, and then the standard error of it, okay, like this. And then cross-validation, minimum deviance selection, okay? You can do it like this. Over here, you see the line shown up over here, minimum, and then afterwards, it's increasing. You start from the rightmost and then, all right? CV, cross-validation, one standard error, selection. If you run it, it looks like this, right? And then here in semiconductor regression, it is not that dramatic compared to the ones you saw with the web online spending data. So case by case, the data by data, right? It may look different, but yeah, that's the thing. I wish it were like a U-shaped or something, but that's that. And then AIC, BIC, yes, threshold, yeah, BIC graph, AIC graph, right? Corrected version, yes, you can do it like this, and then BIC, AIC, cut, or all these kind of things. You can see the information criteria numbers, right, are shown down like this, okay? That's pretty much it. And then web browsing data, you can work on it, okay? Yes, so web browsing data, same package, right? Gambler, right? And then I'm gonna use that one and then read in those data instead of semiconductor, right? And then machine totals as vectors, that's what. Get total visits per machine and percentage of time on each site. Yeah, right. And then use this information in a sparse matrix to do the, yeah, like this, right? What sites did household 1 visit? Looking at your site visit history. Okay, and now read in the spending data. Okay, take it up, and then run a lasso path plot. Okay, let's do it. Okay, it looks like this. Okay, So lambda, you start from the big to small, okay? And then at the very big lambda, you have 0 betas, right? All betas are 0 over here. But after a certain point, one beta starts up. I am significant, like this, yes. And then the second beta, third beta, like that. Some betas are negative like this, right? In predicting those spending, okay? And then run a stepwise regression plot, okay? Okay. And then stepwise. If you run a stepwise regression using this kind of framework, right? Then what happens is that it is less stable, which means as lambda decreases, okay, lambda decreases, all of a sudden a certain beta pops up like crazy, boom, and then it just disappears a little bit instead of constantly increasing or uniformly increasing or decreasing. Here, its beta is just fluctuating over way, right? It's more unstable, okay? That's what we find. And then the coefficient selected as AICC, yes, and then all those selected variables, right? Yeah. So that you can see which variables are significant versus not. All these kind of things you can do. Coefficient on spender, BIC, okay? You can try it. And like this, right? Oh, some of the variables shown up as significant predictors, right? The others are garbages, okay? AIC, spender, yes. And then cross-validation of spender with this, right? You do, what is it? The folded approach of cross-validation, and then run what? The lasso, right? Yeah. And then, okay. Right. And then plot them together like this. It will look like that. Okay? So what you see on your left-hand side is log lambda and mean squared errors with cross-validation trial. Each cross-validation trial for each given lambda is on one line over here. Okay? So many cross-validations, so you have standard errors with means over here of MSE, right? Many times you regressed it, right? And then those mean squared errors, right? Actually starting from the big lambda, right? It starts to decrease. I told you before, the bias and variance decreases as your model gets more sophisticated or more variables thrown in, right? And then at a certain point, you're starting to overfit it, right? So overfitting shows up in the sense that your variance of your MSE, the MSE goes up, okay? The variance goes up. Right, so that's what's going on over here. You want to take the minimum point of MSE and then one standard error away from it, okay, to be more conservative. This is the cutting point where you say, oh, this is the number of variables that I want to stop at, okay? So that's that. And then the right-hand side is our lasso plot, the path plot of those betas, starting from the rightmost and then going to the left, right? And then log lambda selected under various criteria, right? Like this, yeah. And then plot cross-validation results and the various ICs, right? Like this. Yeah. And what you see on your right-hand side is log lambda and then information criteria over here, AIC and BIC. AIC, that original one is in brown, and then AIC corrected one is the black, and you want to go for the minimum AIC corrected. Okay? And then how about BIC, Bayesian Information Criteria? You stop at over here. So remember, log lambda, you start from the right. So no variables selected, and then increasingly more variables are selected as you, in your picture, in your, in your video, okay? It goes this direction, but my direction is like from this to that, right? So as you increase the number, the BIC stops at the most conservative one. And then AICC is rather more suitable for optimal for usual business data science setting. All metrics, I mean, the BIC, right, is being much more conservative, but there is a concern of what? Underfitting, right? Underfitting area over here. That this one is overfitting area, that one is underfitting area. So BIC is more closer to that underfitting area. So we'd rather go for AICC corrected version, right? All metrics together in one plot. Yes, it looks like this. And let's see. Okay. Everything over here, and then shall I draw it in a different ways? Yeah. So PAR, yeah. All in one. That one has to be big. So I would say big. Yes, like this. Okay. So AIC, BIC dotted line shows, okay, together with this, what is it? The plots of Lasso, okay? So that is it, okay? Thanks for watching. All right, so this time I think I'll have to explain to you about the data that I gave you for the midterm exam, I would say, okay? Instead of having offline one short exam, I think I'm going to give you long project kind of things that you can take it in 1 week and then submit the report, okay? Okay, what's the data? Okay, the major part of the data, okay, major data, which means there may be some other smaller data that I want you to work on, but this is hopefully this is going to be the major and the most important part. Okay, I first of all, if I open up this data, okay, this is 100720, right? October 07, 2020. That's the pattern I create my file name, okay, so that I would not forget about it. Yeah, the date of creation, honestly, right? And bankruptcy data, numbers only. But why is that so? Because previously I uploaded the previous version of it with some character variables over there, like CEO name, company name, and things like that. But it turned out that when I was running regressions using those initial data set, there was an error message saying that there's something wrong with this character. I don't know how to run a regression with this character, blah blah blah, like that. So I decided to give you a numerical variables data set only, okay, taking out all those character variables, okay. So this is it. And then a lot of items. By the way, the row, okay, number of observations, well, how many? 27,618 observations, because the first line is not an observation. Okay, and the column wise, how far does it go? BZ, it's like 56, 52 different variables are there, right? Is that right? Not just 56. 26 times 3, because A to Z, and then AA to AZ, and then BA to BZ. So it's like 26 times 3. It's like what? 88 or something. So that's that. What does this data carry to you? Okay. Let me go through the variable names so that you will have some good idea about this data. Okay. So here, I open up. Where is that? That is explained. Yes. Execute comp with bankruptcy data variable explained. So this one gives a definition of variables. Okay. By the way, just to check, right? Everybody knows this, but one column is one variable. One column, one variable, one column, one variable, like this. So we have many variables, many columns, right? That means, and then many more observations. But the thing is, let me state it up front. This is company identification number according to S&P. Okay, GV key. And I assigned GV key 2 just for my recognition here. And then, so one company is repetitively showing up 92 all the way up to 2002. Okay, fine. The next company, each fiscal year, right? You see this guy is coming up. And then Cooper roll, what is that? That is the identification number between for each match of company and CEO. For example, this company, I don't know the name of this company. It goes until 2002, but the CEO changed. Okay, one CEO, okay, first guy remained until most of the part of 1996, and it switched to the next CEO in the subsequent year. Of course, the CEO can switch at any random time, but as long as the CEO stayed in that fiscal year, 1996, right? 97 is gone, okay? But 98, then this guy is identified as one, the John Smith with company A, and then Sarah with the company A. That gets a different identification number. Interestingly, there is missing value for the company, what is it? The fiscal year for some reason I don't know. But likewise, the ID setting is just a pair ID. Okay, pair. Company and CEO pair ID. And then this is fiscal year. Okay, 회계연도. And this is age of the CEO. Okay. And then turnover is identification or dummy variable if there was a CEO changing subsequent year. So for example, 1996 for CEO one over here, the guy stayed until 1996 and 97 got kicked out. Okay, so 1996 I highlighted as 1. Why is that the case? Because when you do some turnover prediction, when does the CEO gets kicked out? For that kind of regression purpose, this is better. Okay, this is kind of a lead figure. Okay, 선행변수 kind of things, right? That's going to happen in the next fiscal year, 1997. So that's why I pull it to 1996. Okay, 0 means there's no turnover. The guy is staying his butt over there. Sticking his butt over there, right? Okay. Things like that. So turnover is there. And then turnover, yeah, that's one implicit incentive to drive, to make the person work hard, right? So in addition to CEO compensation, 연봉 versus 너 잘라, it's like I'm going to kick you out, right? Otherwise you work hard, right? That's turnover, okay? And then that is economic incentive indeed. And then, what is it? Pay. You work hard, I pay you more, right? You work hard, I pay you more. You don't work hard, I'm going to kick you out. So that's the distinction. Whether the guy was fired or voluntarily retired, it does not distinguish over here. So they are mixed, okay? And then MVE, guess what? That is market value of equity. So market cap is this guy. In $1,000 unit or something. Yeah. And then bankruptcy identification is shown over here. If the company filed for bankruptcy in the next year, just like just like the CEO turnover, right? It's a lead variable. Okay. If not bankrupt next year, it's just 0. Okay, healthy company, fine. And then restate is what? It's also lead variable. Okay, and if the company had cosmetic accounting, 분식회계 kind of things, right? Accounting, fraudulent accounting, so that they had to restate their financial statements in the following year. Then this year they have the dummy variable 1. Otherwise, it is 0. Okay. TDC1. So for this, the rest of the part, let me go down to the next file, which is about the variable definition. By the way, this set, okay, this set is coming from execute-comp data. Execute-comp. What is that? That is the CEO pay data. CEO pay data of 1,500 largest companies in the U.S. Publicly traded U.S. companies. S&P 1,500, I would say. Okay. So that includes S&P 500, the biggest 500 companies, and then 400 small caps and 600 mid caps and kind of things, right? So 1,500 is there, okay? And then their pay data is basically here, and I merged those accounting data and stock return data, stock performance, and then other things as well. The bankruptcy data, I merged it, and let's go through one by one so that you're going to be able to have some better idea when you do your midterm kind of project. Okay, so I sorted the variable, sorted the data with respect to the variables alphabetically. Starts from A, and then what you see on your left hand side is a label of this guy, the explanation part. So variable name, this one variable is the one you are going to see on top of each of the columns over here. Okay, that one is in alphabetical order, whereas this one is not. So it may be confusing a little bit, but you can trace at least over here. Oh, has I in the CPA or CPA? Go to H and you can find it. Okay, we start with acquired. Okay, acquired is a dummy variable. Dummy variable that is 1 if the company acquired a certain other target company. Okay, in that fiscal year. Contemporaneous, the same time. It's not a lead variable. Okay, acquisition count, right? Acquisition count is the number of acquisitions this company did. Okay, how many companies did this guy acquire? 1, 2, 3, or only 1. Okay, so that shows up over here. Count variable. 0. Okay, it can happen. Why do we care about it? Well, I told you, acquisition is a major corporate event. And then if you are creating a venture, okay, you want to sell your company at a certain point of time, okay? Then you want to have some idea about what kind of companies are more likely to, which companies are more acquisitive, has more tendency to acquire other companies. That is coming from this kind of variable, and you can estimate it, right? Acquisition prediction, you can do that. Add MAR, this is like advertisement expense divided by sales. Whatever MAR, right, ends with MAR means like margin, okay? That's the way I just label any variable. Add is advertisement. Age, that's CEO's age. Yeah, how old is that guy, right? And then alpha S&P 5, SP3 is like alpha, okay, using S&P 500 index return over 3 years. You can think about CAPM regression kind of setting, and for that company or specific company, okay, I run a regression of that company's monthly return over the past trailing 3 years against the S&P 500 index return, market, CAPM regression, and then not CAPM regression, but the index market model, right? I don't subtract the risk-free rate. That's why I say market model. By the way, by that, I estimate the beta and alpha of that stock. Remember that beta and alpha has to do with some excess return or excess return that is not explained by the market factor. So that's the company's performance in that CAPM setting kind of things. Okay. AT is asset total. Okay, asset total. And then bankrupt, I told you, the country filed for bankruptcy next year. And BEME is like book value of equity to market cap, market value of equity, BEME. Why not PB ratio? Okay, PB ratio, industry guys favor PB, whereas academicians go for book value of equity over market value of equity, BEME. Price, it's the same as market cap, right? But why do we flip it? Okay, guess what? This book value can go to what? 0. Then you are in trouble because this whole number explodes meaninglessly. And then if it goes to minus, what does negative PB ratio tell us? Not much. Whereas over here, market value is always positive. Okay? Cannot go to 0 because the market equity has a call option feature in it. It's like a market value of equity. Equity is a call option upon company's asset. Okay? Call option whose strike price is the face value of that amount. Okay? So you can choose to exercise because of the limited liability feature, right? You can choose to exercise the right to get the residual value as an equity holder. That's a call option. Okay, if your asset value is lower than the debt amount, then forget about it. Don't exercise your value. Okay, don't exercise your right, and then let it go. Market value of equity, right? Forget it. So you have that kind of a call option feature. And then the debt is not matured, so this call option is before maturity. So the value of call option is always slightly positive because there is always an uncertainty associated with it. So the denominator over here is always positive. So that is advantageous. It does not go to 0. So the number does not explode over here. So that's why academicians prefer book value to market value, this measure over here. Where is that? Where are you? BEME. Yes. Okay. And then beta S&P 3, right? So I told you about this alpha using those S&P return, right? And then your company's return. I run regressions, and then it goes like this. Alpha is that guy, and the beta is this guy, the slope term. So that's what's going on. Bonus, that's CEO's pay bonus year by year. Okay? The CEO's compensation, by the way, compensation has 3 elements, which is cash, roughly 3 elements. Cash plus bonus, cash bonus. Oh, no. Did I say cash? No. Compensation, pay, I should say pay to CEO has 3 components, which is salary, salary plus bonus, and then equity compensation. And salary is just fixed one, okay? 고정급, okay? No matter what, they will pay you. But Bonus has to do with your performance. You hit some accounting-based benchmark, ROE. Okay, let's say your ROE achieves certain level, then you get $1 million or something. Or your sales grow by more than 20%, you get X%, X dollar of bonus, right? These two are cash, okay, cash items, cash payment, right? An equity component is a huge chunk, right? It's non-cash, but it either comes in the form of call option or call option, should I say call option, and then stock ownership. Okay, stock ownership, call option, two ways, right? So three components: salary, bonus, and this equity component is here, and this pay in executive comp data is labeled as TDC1. TDC1, you're gonna see later, TDC1, okay? Those aggregate amount of compensation. You're gonna be amazed by looking at the average TDC of the CEOs, right? Look at your own pay, right? You become CPA and then you think you're gonna be rich. Wake up, man. TDC over here will just wake. This is gonna be a wake-up call for you, right? This is why we are encouraging you to become the CEO rather than being a salaryman or something like that, right? That's American setting, and the Korean setting is also going there. Look at the pay of Samsung Electronics CEO. It's equivalent, all right? Major part of it comes from this call option and stock, but that's something we're going to talk later. Bonus is this part, the dollar amount that is you get paid. CapEx, right, is this guy, capital expenditure, how much you invest. And CapEx AT, whatever AT is like a divided by asset total, right? Why? Because different companies have different size. So what's the percentage? Okay, that's the issue. Whereas CapEx over here is simple dollar amount in $1 million unit or something. And then cash AT, that's correct. You guessed it right. Cash divided by asset. And then CEQ, that's common equity. Okay, common equity. Okay, 보통주, like a book value of equity for common shareholders, right? And then there you see an interesting variable that I manually or hand collected for thousands and thousands of CFOs. Over here, okay, CPA, CFO CPA. What the heck does that mean? Don't say that this is a dummy variable, that is if the CFO has a CPA license or something. Yes, you guessed it right. And over here, for that company, right, in that specific year, I looked at those CFOs. Of course, not just myself, but my diligent RAs from Singapore. And then they diligently collected by Google searching like crazy. And then identified, one, if the CFO person has CPA license over there, okay? And then MBA, we also collected whether those CFO has MBA degree, okay? Here, remember this one, the compensation is CEO pay, but I have match merged with CFO's CPA or MBA kind of things. Why? The CFO's financial expertise, okay, may matter sometimes. That's why I was interested in it, okay? Does it have any prediction for bankruptcy or anything? That's something you can explore, okay? I don't know, okay? It may, okay? May not. What's your story over there, right? Tell me. Chairman, CEO, all, that's a dummy variable. One, if the CEO happens to be the chairman of the board of directors of the company. What? The chairman of the board, the CEO is working hard like this as the top guy in the corporate pyramid, right? The CEO, okay? Board of directors, who is it? They are the representative of the shareholders. This is a company that is the shareholders, okay? Or shareholders are here, and rather this is board of directors, a group of person that represents this shareholders, right? The owner groups, right? Not just the single owner, but the owner groups, right? Shareholders, board of directors, and their board of directors, there has to be some chairman, okay, whose job is to what? Supervise this guy or monitor whether this guy is not doing something wrong, okay? Monitor. So there has to be some tension between these two, right? We call it good corporate governance, good monitor. If these two people, two persons are different, make sense? If, on the other hand, if these two guys are identical, okay, if this two guy is Andy Kim watching over Andy Kim, what would happen? Oh, that couldn't be better for Andy Kim because I'm monitoring myself and I'm like, yeah, I'm doing great all the time, okay? And I can screw up the company as much as I can and nobody cares, nobody can fire me. That's this situation. That's chairman equals CEO. Okay, we call it bad governance, right? 지배구조 bad, right? That's this situation. All right, corporate governance is there. Corporate role, okay, corporate role, I told you about this, is just a simple identification number. And then code name, I just dropped it in your data because it's text one. CSR, corporate social responsibility. Yes, I included that. Yes. This number is given by KLD, right? Those KLD is an organization that measures, evaluates the CSR performance as a third party, okay? And then they have a whole bunch of items to check whether this company is good or bad in a certain way or another. For example, does this company manage good for employee relations, good or bad? So good, adding one more score, bad, 0 or -1, okay? And then, yeah, 1 and -1, okay? That's it. And then employee relations, environmental concerns, and then product safety, and then nuclear related danger, right? Product toxification kind of things. All those things, they evaluate the company and add up those scores, right? Adding 1 for each item, okay? Subtracting 1 as well. So you will see a whole spectrum of CSR performance year by year, right? So that's this guy. And then current ratio is something you must be familiar with, right? Accounting number, current asset divided by, current asset divided by current liabilities, right? Okay, that's it. And then data date, I excluded this one in your numerical data because this is date format, okay? It does not go well with your lasso kind of regression setting. Anyway, so data date, that's fiscal year end date. I just eliminated. We have fiscal year number in it, so no worries. DLC is debt in current liabilities. Total current liability, total debt, right? Debt in current liabilities. Isn't the debt the same as liabilities? And the answer is no. Why? Debt means interest-bearing debt, something you borrowed from the bank or you borrowed with the corporate bond issuance, right? Or commercial paper, something you have to pay the interest explicitly. Whereas liabilities is a whole bunch of liabilities together with the debt, non-interest incurring obligation like accounts payable, all those kind of things. The deferred tax liabilities. That's liabilities, not debt. Okay, that's the distinction. Here it's about debt. Why do I care about the debt? Because of the leverage ratio, financial leverage. When it comes to bankruptcy issues, it's about that financial leverage, debt, okay, interest-bearing debt. How much can you take care of this debt? Okay, is directly related to your bankruptcy probability. That's why. And then long-term debt issuance and then long-term debt total for that given fiscal year end are shown over here. Depreciation and amortization, and you see that this data has a whole mixture of what? Balance sheet items and income state items, right? Some of them are stock figures and some of them are flow figures. So you have to be careful about interpreting your results later on, okay? And then depreciation and amortization in cash flow statement account, right? That's that. Cash dividend in your stated in cash flow statement is shown over here. And then here, I included one very interesting variable, which is early exerciser 33. What the heck does that mean? Well, it's an identification or dummy variable for the CEOs who is diffident, who is lack of confidence, supposedly. Okay, what? Come on, that's not accounting number, that's not finance number, it's a psychology number. Yeah, I am a behavioral finance guy, you know that. And there's a whole bunch of papers, whole bunch of literature about CEOs' overconfidence and underconfidence, right? This is about underconfidence or diffidence, right? Diffident. How do we measure this, whether the CEO is overconfident or diffident? Well, here is one way proposed by Malman, DA, and Tate in UC Berkeley. The idea goes back to the option, call option, okay? So here's the timeline. Okay, here's the timeline. And here's the stock price. Okay, stock price. And here's the timeline. And then the stock price may start from certain point. Let's say this point. Let me stay. Yeah, change the color. The option, right? Compensation, right? Let's say this is the strike price, K, of your call option for the CEO. Okay? And then it is granted to the CEO at a certain point of time and then starts to move around. Okay? Right? Like this. Okay. Now, your CEO's option compensation expires in 7 years or like 5 years or something like that. And then the guy can start to exercise after maybe 3 years. Okay. Now it's vested after this and then until expiration date. Let's say this is big T, right? Expiration date, expire. Okay, and starting from here to there, you can exercise the call option at any time. Okay, so it's like an American option. Now it is vested. We say vested. Why is it called vested? You can think of it like a it's like a gunfighter's vest. Okay, bullet jacket that is bulletproof, and then you also the vest. You have some bullets in it as well so that you can shoot. It's vested. You are ready to shoot this and then exercise the call option. This is a vested period. Okay? So now the CEO starts to have that option to be able to exercise. Okay? Now the question becomes like this. Your stock, okay, at this point, this period of time, the theory says, first of all, okay, for American call option, if you think about the option basics, American call option, what is the optimal time to exercise it? Should you exercise earlier or should you wait until the final day, expiration date? And the answer is expiration date, because there is always an uncertainty that the price may go up like crazy. So why do you exercise early? Okay, that's first question, first of all, right? First point. And then number two, okay, more important is this one. Let's say your stock moves around like this, but let's say over like this. Okay. It can go up, it can go down like crazy, it can go stay over here. You don't know. Okay. But some CEOs, would they want to exercise this and cash out early, or would they want to wait until the expiration date so that it will be theoretically optimal from American option standpoint? Okay, would you, if you are the CEO and you are vested with call option, right? And then your stock and your option is in the money, which means your price is above this strike price like this. Okay, above the strike price. Okay, and many years are left. Okay, would you exercise this option if you stand over here? Would you stand over here? Would you exercise this option right now and cash out? Or would you wait until the final day and then wait for the chance? Is a valid question. Okay? The simple American call option theory says that you have to wait. But if you go back to, if you think about the CEO's personal perspective, he or she is not a well-diversified portfolio manager. So that waiting until the final day may be suboptimal. Okay? i.e., your whole asset, like your whole human capital is invested in your company right now, 100%. It's not well diversified, it's concentrated. And your major part of your financial asset, okay, all your money is put onto this option right now, okay, option, and the stock, you are 100% concentrated on the company itself. You're not a well diversified portfolio manager. So you're in trouble, man. As a rational human being, you would be afraid. So that you want to diversify away as much as possible, which means in this kind of setting, if you're standing over here, what would you do? Exercise the option right away and then cash out and diversify into other companies, perhaps your competitor stock. Man. No, that's I don't suggest that, but some people may do that, right? So that's what rational people will do. Now comes the psychology, the overconfident CEOs. Okay, overconfident CEOs, what would he or she do? Standing at this point, okay, your stock is in the money, you can exercise it and cash out, you can party based on it. Would you exercise it? If you are overconfident, if you are rational, you will exercise right away. Okay? But if you're overconfident that you believe that the company will be great, my great company is under-recognized right now. The investors in the market, they don't know the true value of my company. My company's true value has to be somewhere over the sky. And right now we are here. So, if you are confident that your company will reach this level, would you ever exercise this option? Is a valid question. And the answer is no. Right? So they would not exercise those in the money call option and wait. Oh, wait a minute. It's not still there. Okay? That's overconfidence shown up in their option exercise behavior. That's the story of overconfidence identified with their option compensation. So we are going to have that overconfidence identifier later on. But here what you see is the other way around, the opposite of overconfidence, which is like underconfidence. My company's stock price is over here, but I'm not confident. And then for some reason, right, that I don't know, the value is just good enough. Maybe the true value is down there. So while this price or the option is in the money, why don't I just exercise? Okay? Quickly. Okay? That's underconfidence issue, a confidence identification. So early exercise 33, what does this 33 mean? Well, here, this is 0 to strike price. This is, let's say this is 100%. Okay, 100%. And then if the call option is in the money by 33%, if the 33%, above, if the stock price is 33% or less above the strike price, then and then the CEO exercised this call option, then this identifier says 1. This guy is underconfident or diffident. Okay? Early exerciser over here. That's this guy. Overconfident guys, we have different threshold, like a 30, is it 30? 67% above the strike price, there is a threshold, okay? Then people construct a different threshold, like 100%, 200% to 300% level, all the way up to the sky like that, okay? So different degrees of overconfidence and underconfidence is there. Here I gave you one underconfident CEO psychology variable. If the CEO is less confident, then is the company more likely to hit bankruptcy? That's something you may want to explore, maybe. Okay, that's the idea over here. Now EMP, that's number of employees, the next variable. Okay, we scroll down. And then exec first name, full name, last name, and middle name. Forget about it. I just deleted those things. But some researchers go through this name spelling in behavioral finance. Believe me. The name spelling more like what? Immigrants, right? How do they perform? Better or worse, right? That kind of research has been going on. The cultural issue, Chinese sounding name, Korean sounding name, right? Last name tells us about that. So that's the thing you can leverage if you do some text analysis. And then exec ID, that's executive ID, identification number, CEO's identification number. How is it different from corporate role? That corporate role is ID for match of one exec with one company. The thing is, Steve Jobs is not only the CEO of Apple, but used to be the CEO of another company called what? Pixar? Yeah. So the same guy may show up in two different places, two different companies. So corporate role will be different for each different cases, but exec ID will be identical throughout. Okay, that's the thing. Firm age, how old is the company? Yeah, it's over here. And then GV key, I told you that's the company identification number in CompuStat. Okay, CompuStat is the data set provided by S&P, the rating agency, credit rating. You remember that? Right. That's the company ID. Has in the CPA. What? Does it have anything to do with our holy CPA? Yes, it is. Right. In what sense? I hand collected, okay, for thousands of companies for many years, right? My RAs, honestly, right? Diligently collected whether the company, the independent directors, at least one of the independent director members have CPA license in it to identify those financial expertise, right? Or accounting expertise. So this variable will be 1 if there's at least one CPA guy in the independent directors list, okay? Independent directors, they are supposed to be the monitors. The board of directors have two functions, which is monitoring the CEO and then advising the CEO, okay? Advising. That's board of directors role, okay? Yeah. And monitoring, you need some expertise in it. So that's why, okay? Does that have anything to do with that? Has anything to do with the company's bankruptcy chance? Things like that. Female directors, yes, we looked at the gender identification for independent directors. If there was at least one female over there, it is 1. Okay, otherwise 0. Foreign directors, yes, the same thing. If the board of directors, independent directors have at least one foreigners over there, it's 1, otherwise 0. And then has independent directors with MBA degrees, 1, same thing. Okay, this expertise issue is there, and diversity issue of the board is an important aspect in corporate finance. Does it have anything to do with bankruptcy? I don't know. You can test it, right? Okay. And then institutional ownership. Holy cow! That's percentage owned by the 기관 institutions like mutual fund or pension fund, all these kind of things, right? Then Kurt read, that's kurtosis of return. So statistics moment. First moment of any statistics is what? Mean. And then second moment is variance, right? Third moment is skewness, okay? And the kurtosis is the fourth moment, right? 첨도, how pointed is it in that center of mean and then dispersed at the fat tail do you have, right? In the extreme, right? That's this measure. Does this have anything to do with bankruptcy? You go ahead and test it. Lag data date, this is the lag variable of data date, fiscal year end date of last fiscal year. I dropped it. Lawsuit 1, wow. I collected it from Stanford database, hand collected, right? Using my mobilizing my RAs like crazy. And if there was a lawsuit in that concurrent fiscal year, the same fiscal year, it is 1, otherwise 0. It's not a lead variable, so you have to watch out. Lead data date, yeah, I just dropped it. Lead TDC 1, that's total compensation, right? Total compensation in the following year, in the coming year, right? Lead variable is there. And then long holding 67, that's overconfidence measure. I told you about this overconfidence measure, how you do it, okay? And then identification of gender of the CEO, male dummy is here. If it is female, 0, okay? And you can check out the percentage of female CEOs in the US right now, not right now, until 2008. Year by year, you can get some idea about it. Okay. Excuse me. ME, I told you market value of equity. MTB, that's book market value to book value. Okay. It's like PB ratio. Is that right? PB ratio kind of things. MVE, again, market value of equity, fiscal year end. Those two has to be the same, but somehow I just measured it. Check out if they are the same. I measured it different point of time, but should be the same number. But let's see if it is not. Yeah, you can drop one of them. Anyway, and then NI, that's net income. OIBDP, that's operating income before depreciation, okay? Close to EBITDA, right? Close to EBITDA. And then OROA, that's common measure of ROA in finance research, which is OIBDP over asset total, okay? Oh, that's not net income based. You're right. But in finance research, we just go with this operating cash flow kind of income divided by total asset. Okay. Why is that the case? Because operating income, first of all, goes to both equity holders and debt holders. And asset is both equity holders and debt holders. So numerator, denominator, we are being consistent. And we want to add back those depreciation because that's non-cash items. So roughly, it's operating cash flow, okay, for $1 of assets that you invested as a book value of investment, right? So that's the idea over here. And then talking about this OROA, there could be some alternative measures of OROA depending on what you use as the denominator. The denominator OROA is like concurrent asset total, right? End of fiscal year end. And then the numerator is the earnings that you got during this year. But if you think about it, well, that's not a starting balance, right? So the numerator being starting balance is lag AT, that's OROA 3, okay? And then there is a compromise between these two. That's average of asset in two different point of time as a numerator, and then the denominator, and the numerator has to be YBDP. Okay? That's it. And then perm number is here. Perm no, that's another identification number. The silly thing about working with US data is that their company identification number for the same company, I mean, they have different structures of identification numbers. One, you saw it, GV key, right? CompuStat based one, okay? That's accounting data ID. And then perm number, which is stock return data, okay? Which is coming from CRISP. That is different from CompuStat. CRISP is CRSP, CRSP. That's Center for Research of Security Prices in Chicago. Chicago. Yeah, University of Chicago, Eugene Pharma. That group has a whole huge institution that collects this stock return data, stock price data. That's CRISP. And then just like Krispy Kreme, CRISP. And then they have their own identification structure for the same company. So I had to match them, right? Which perm number is the same as which GV key over there. Tedious thing, I did it for you, okay? And then this is PPE EMP, that is fixed assets, PPE per employee. So divided by the number of employees, I say. And then how much of fixed assets does the company have per head of the company, the employees? PPE GT, that is what? Gross total of PPE, the dollar amount, and net amount, the dollar. And Q is Tobin's Q over here. Economist, right? If you want to impress any economics professor, say something about Tobin's Q, right? Tobin's Q, they're going to be, whoa, you know something about economics, right? That's this guy. Market value of asset divided by book value of asset, or by replacement cost. Historically, how much you spent, how much you invested. That's the denominator. And numerator is the market value of this. Okay? So for each dollar that you invested in this asset, how much does the market evaluate for you? Okay? You want the market to be evaluating more than what you invested. So the Tobin's Q, you want it to be bigger than 1. Okay? If Tobin's Q is less than 1, you're in trouble. You're in distress. Okay? That's the idea. Okay? And then the next variable is KMV-EDF. You won't believe it. KMV-EDF. Go search what this guy is. KMV. And this one, okay, is basically providing the data about the companies, each company's probability of bankruptcy. And that's EDF, expected default frequency. Okay? What's the chance that this guy will go bankrupt based on certain model? And that model is identical to the one that I told you about. Equity, right? Equity is nothing but a call option on asset. Understanding the book value of debt as the strike price. Equity has a call option feature. And then for that part, they introduced this kind of, option valuation technique for each and every corporations, and then estimate those default probability, back solving the volatility kind of things, right? That's this guy, okay? Awfully sexy number, right? This really drove me to pursue PhD, okay, when I was working at Bank of America. And then after working hard, getting PhD, and then I got a position in the NTU. I called up the KMV guy. Okay, now it is in Moody's KMV, right? And then they provided for free for me for academic research purpose only. So you have to promise me that you will be in your email, right? That you will be using my data only for this class and only for this academic purpose. Whenever you use for other purposes, you need my approval, and so that has to be the strictly abided by. Okay. Yeah, basically you can work out so that you can produce some kind of master's thesis, 석사학위 논문 at least, based on this, right? I'm giving you to the undergraduate students because, I'm in charge of you guys and I like you guys. Yeah, right? Let's go to the extreme. Yeah, that's it. Restate, I told you, this is the identification number. If the company restated their statement the following year. Red 12B, that's stock return over the fiscal year, 12 months return, okay? So each different companies, right? Red vol, that's standard deviation of return, total risk of the companies measured in the stock market. And then red V, that's what? Rev T, that's revenue total, that's sales amount, okay? R&D AT, that's R&D expenditure divided by total asset. R&D margin, that's over sales. And ROE, we have three different versions, just like OROA, right? Net income divided by equity, but whether it is fiscal year end equity or beginning equity or average of it, okay? Depending on that, you have three different versions. I just throw it in, okay? So think about multicollinearity, okay? If you throw in all these variables, what will happen to the regression model, right? Guess what? Later on. Okay, salary is there. I told you this is a fixed pay to the CEO. 짬밥 tells you about the salary. As long as you stay over there, you get paid a little bit increased year by year with the seniority. Anyway, SEQ, that's book value of equity, stockholders' equity of the parent company. You CPA guys, don't question it. This is just consolidated basis, okay? So just don't ask me whether it is consolidated basis or independent basis. Just take it, okay? Sigma SP3, right? That's what? Idiosyncratic volatility using S&P 500 index, a return over 3 years. So I told you about this, right? S&P market return, okay? And then this is your company's return, RM. And then run a regression, and there must be some residuals, right? So this sigma is about this residual. How volatile is this residual? Okay? How far away is it? Okay? Sigma. That's this guy. The sigma. All right? Idiosyncratic risk, firm specific risk, CEO going crazy. That's this part. Anyway, size A, that's company size measured with total assets, but I take the log of it already. So that's this one. And then size M, the size variable measured with market value of equity. Market cap based size. I take the log of it. Why? Because those two variables are highly skewed in the first place. Extreme big size companies are there, but majority of them are clustered at lower level. Okay? So we want it to be a bell shaped. So that's why I take the log of it. Skew return, skewness of return, right? Is shown over here, whether you have extreme boom of your stock return or extreme crash of your stock return. That's captured by this guy. STD, RET, that's standard deviation of return. That's volatility. Red vol should be the same as this guy. Identical variable showing up twice. Yeah, you can eliminate one. STD, SPRN, standard deviation of SPRTRN, right? So this one is a volatility of market index return. So it tells you about the degree of market risk at certain point of time, okay, of certain fiscal year. And then TDC1, okay, TDC1, that's what? Total compensation. You see the components in it: salary, bonus, and other annual restricted stock grants and long-term incentive payouts, all other and value of option grants, right? So salary, bonus, and the rest of them. Majorly option and then stock, okay? Stocks granted, okay? That's it. Some of you may wonder, 우리 사주 kind of things, employee stock ownership, isn't it the same as this one? Equivalent idea, yes, but the magnitude is different. The number of shares given to the CEO is not just 10 or 100. It's like 1,000,000 shares or 10,000 shares given to him or her, right? Tenure, too, is CEO tenure. How long has this guy been in that CEO position? Tick is a ticker symbol. I just dropped it because this is character variable. Title and this is, I also dropped it, is CEO identification. TLTA, that's leverage ratio, total debt to total assets, okay? Total CUR, that's total current compensation. Current compensation, that's salary plus bonus, okay? Why do we call it current? This is currently given to you in cash, whereas the other items like grants and options over here is not cashed out right away. You still have a choice. That's why. Turnover, I told you whether the guy was kicked out or not, or retired or not as well, right? And then XAD is advertisement expense, the dollar amount. Of course, all those dollar amounts are in the unit of $1 million, by the way. And then the year, right, is fiscal year. So those variables are there to explore. I am basically donating the whole thing to you, okay, for your development. And then exercise yourself and have some fun in your own way, okay? Find out some interesting pattern, just report to me, okay? Let me see what you find. But the final, the midterm exam will be about default prediction. You have bankruptcy dummy variable. That should be your dummy variable, or the dependent variable. And then you have to throw in all the other variables on the right-hand side and see, right? So that's the idea, basically. And then I may give you, based on this data, I may give you some equivalent task for midterm exam. I'm going to write out the statement of exams so that you will be able to go through, okay? But this is the rough idea about the midterm exam, okay? So explore it yourself and have some fun over there and then impress me, okay? So that's that. I hope you liked it, and then see you.